Ladies and gentlemen, good day and welcome to Baazar Style Retail Limited Q2 H1 FY'25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shreyas Samant from Stellar IR Advisors. Thank you, and over to you, sir.
Good evening, everyone, and thank you for joining us today. I have with us today the senior management team of Baazar Style Retail Limited, Mr. Shreyansh Surana, Managing Director, and Mr. Nitin Singhania, Chief Financial Officer, who will represent Baazar Style Retail Limited on the call. The management will be sharing operating and financial highlights for the quarter and half year ended September 30, 2024, followed by a question and answer session. Please note, this call may contain some of the forward-looking statements which are completely based upon our beliefs, opinions, and expectations as of today. These statements are not a guarantee of a future performance and involve unforeseen risks and uncertainties. The company also undertakes no obligation to update any forward-looking statement to reflect further developments that occur after a statement is made. I now hand over the conference to Mr. Shreyansh Surana. Thank you, and over to you, sir.
Thank you. Good evening, everyone. Welcome to our Q2 and H1 FY'25 earnings calls. Our presentation has been uploaded on the exchange and company's website, and I hope you had a chance to go through it. I would like to begin by highlighting that we are witnessing strong demand trends with some betterment in consumer sentiment. As you may be aware, there have been significant structural shifts in the market as far as consumer segments are concerned. Consumers are increasingly moving towards organized channels. This trend is proving to be a key tailwind for our business as consumer preference continue to evolve with a stronger focus on brand consciousness at affordable pricing. Additionally, in Q2 FY'25, the festival demand also fueled the growth further, as Durga Puja was advanced by 10 days this year, thereby benefiting us from our strong presence in East India markets. Overall, the demand scenario continues to remain strong as we speak. As things stand, we believe that the second half of the current fiscal is also likely to remain strong. To capitalize on this opportunity, we have stayed committed to our growth strategy and expanded our footprint with addition of 22 stores in H1 FY'25. With this, we are likely to exceed our initial guidance of net addition of 35 stores in FY'25, and we will be clocking about 45 to 50 stores additions in FY'25. Naturally, as you may be aware, store expansion will be associated with incremental cost, mainly on employee front, freight and forward, and advertisement. And this was also the case in Q2 FY'25, wherein other expenses have increased incommensurately to the revenue growth, thereby impacting profitability. However, please note that some of these costs should be considered as front-loaded expenses, and the benefit of this are likely to be accrued in the second half of the fiscal as sales from new stores increases. Basically, we expect profitability or margins to improve in H2 FY'25. Another key highlight we would like to share is the strong traction we are seeing with our private labels. By focusing on differentiation and achieving greater control over product quality, we have been able to enhance the appeal and popularity of our private label offering. As a result, its share of total sales has increased significantly, reaching 49% in H1 FY'25 compared to 38% in H1 FY'24. This represents an impressive year-on-year growth of 79%, with private label sales now totaling 284 crore in H1 FY'25. This growth reflects not only the strength of our product portfolio but also the increasing consumer preference for our in-house brands. We strive to strengthen our market position through deeper penetration in our core market and forming new clusters in focus market. This strategic approach will help us to optimize our marketing spend, streamlining the supply chain cost, and enhancing the inventory management efficiency. We have also reduced our inventory days from 154 days in H1 FY'24 to 137 days in H1 FY'25 due to faster offtake in festival season and increased focus on operational efficiency, bringing in economies of scale and thus reducing the inventory per square feet. Coming to the operational highlights and key financial number for the quarter ended on September 30, 2024, the total income at 313 crore was up 65% year-on-year and 13% quarter-on-quarter. Gross profit at 94 crore, up 71% year-on-year and 4% quarter-on-quarter. EBITDA at rupees 24 crores and EBITDA margin at 7.8%. This was due to increase in other expenses because of store expansion. Just to highlight the financials for H1 FY'25, the total income stood at 592 crore, was up 41% year-on-year. Gross profit at 185 crore, up 43% year-on-year. EBITDA at 66 crore and EBITDA margin at 11.3%. Coming to the key financial metrics in Q2 FY'25, we continue to witness healthy volume growth overall and strong growth in private label sales. The private label contribution increased from 39% in Q2 FY'24 to 45% in Q2 FY'25. In absolute term, it is at 140 crores, up 90% year-on-year. The store count grew 28% year-on-year to 184. The rental area of the stores grew 25% year-on-year to 1.67 million square feet. The average store size in the stood at 9,055 square feet. The total number of bills grew 57% year-on-year to 3.32 millions. The quantities sold grew 59% year-on-year to 11.95 million. The average transaction value grew 5% at 997. Same store sales growth stood at 41%. To this note, and now I conclude our presentation. We will endeavor to continue with this growth momentum going forward. We thank you a lot for listening to us patiently, and now we open the session for question and answer to all of you. Thank you very much.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. An operator will take your name and announce your turn in the question queue. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. We take the first question from the line of Deepak Kumar Singh from Barclays. Please go ahead.
Yeah, hello. Thank you for giving me the opportunity. So my question is I read you have closed one of your store in I think in Andhra Pradesh. What is the reason behind of closing that store? And the second question is how you are doing with the e-commerce, how you are going through e-commerce, that is the future. So these are my two questions.
In terms of Andhra Pradesh, the store that we have shut down, the primary reason was that it was not a profit-making store and we were incurring loss in that store. So due to operational reasons, we have shut down the stores. In terms of e-commerce, currently we are working more on the omni-channel retail model that we have applied in the stores, on which the focus is more. Because what we are seeing is that to create the e-commerce, we have to work on the entire ecosystem. And we are planning on the same, but I think it will take some time to implement to go on the entire e-commerce front. But yeah, in terms of omni-channel, we have started well, and in the first 6 months, we have sold around 1 crore rupees of revenue has come from omni-channel retailing, that is delivery through stores to the consumers.
Okay. Thank you. So I have one more question. When I'm going through your this one store count, you are working as a cluster base, right? So when I saw V2 Retail, which is your competitor, so if you correct me, they are not working on cluster based approach, right? They have one store in West Bengal and other store in tier 1 far away. So they are not working in cluster based, correct?
There are peers who are doing this way as you are saying, but there are also some peers who are opening stores in a cluster format only, V-Mart. So they started with the cluster. Now they have entered into all the geographies. As of now, our focus is more on cluster than any other retailers.
Okay. Thank you for giving me the opportunity. Thank you.
Thank you very much. The next question is from the line of Palash Kawale from Nuvama Wealth. Please go ahead.
Thank you, sir, for the opportunity and congratulations on good set of results. Sir, just wanted to know what was the SSSG for Q3 last year, if you could share that data.
Last year Q3 SSG, right now it's not, this year we have done, for the entire year, for Q2 it has been around 41%, for the entire half yearly it has been around 21%. Yeah, Q3 stands at 50.4% last year.
Sir, on the base of 50%, you are still saying that the growth would be very good. Sir, what is leading to such a good growth for you and other players as well in the value retail segment? Could you throw some color on it? And how sustainable is this growth?
So see, there are two things which is happening. One is I think the market is expanding and a lot of traction is coming from unorganized to the organized, which I have told in previous calls also. So we have seen a lot of traction coming from unorganized to organized. People in the small cities also want to shop in a organized format, where they have a particular, they can go to a store which is air conditioned, where they can get that assistance of the shopping also from the employees. So I think that is one of the key reasons for that. Apart from that, because we are opening so many stores in a particular cluster, that is also helping us to enhance the brand visibility among the consumers. I think these are the 2 points that is helping us to increase our footfall in our stores, and which is again helping us to increase the revenue. Now in terms of L2L growth that we are seeing, the thing is that now we are seeing a lot of sales coming from the existing customers. So 72% of our revenue is coming from the existing customers in the L2L stores. Apart from that, last year Q3, as I said, Durga Puja has preponed by 10 days in this quarter. So obviously Q3 had a higher L2L growth last year of 50.3%. But overall, we are opening stores also in UP, Bihar, everywhere else, which has got a larger chunk of festivities in Q3. So I think because we are opening so many stores, as we speak, we are at 198 stores. So I think a lot of growth is going to come from that focus areas also.
And sir, do you see any risk with?
Yeah, please go ahead with the question.
Yeah, sir, please go ahead if you want to add anything. Yeah.
No, I was just saying that together, both of that will help us to sustain the growth.
Okay, sir. And sir, with all the players being so aggressive, do you see any risk to the demand in such an environment where other players are saying that the consumption demand is not very good? So do you see any risk?
I will say in terms of lower, the audience that whom we are targeting are at the bottom of the pyramid, and I don't see a risk over there. Yeah, there has been a slow demand, but I think more on the FMCG company side, the demand has been sluggish, or maybe on the middle tier, which is a branded wear category, not a ultra luxury category. There may be we are seeing a sluggish demand over there, but at the bottom of the pyramid, the demand is there.
Okay, sir. And sir, with now you also said that you'll be adding more stores than earlier expected. So any change in revenue guidance for this year?
So we are intact to our guidance. Rather, as I said, we have changed our guidance for the number of stores that we have opened. So we were supposed to open around, we planned to open around 35 stores, but we have increased our guidance from 45 to 50 stores will be opened this year. And as of revenue guidance, 25% will be the guidance for this entire year.
Okay, sir. Yeah, sir, that's it from my side. I'll come back in the queue with something. Thank you for your response and all the best.
Thank you.
Thank you. The next question is from the line of Siddharth from Caprise Investment Manager. Please go ahead.
Yeah. So hi, sir. Congratulations for a great set of results. So I've got a few questions. So starting from your, I want to know the reason why the margins have contracted. So we thought, we were of the expectation that we would become like positive in terms of bottom line this quarter. But so could you throw some more light on why we haven't done well in terms of margins?
So in terms of gross margin, see Q2 in quarter 2, in terms of gross margin, if you see from last year we have increased by 1% from 29 point, we have increased to 30.2%. Yeah, overall level there is an increase in cost because we have opened 18 stores in this quarter. Plus there was a preponement of festivals also. So there were a lot of expenditures like advertisement and packaging, freight which were front loaded with the inventory and preponement of the festival. So I think that has led to an increase in cost, the benefit of which we will see in the second half. And as I said, the second half will have a higher profitability. And this is the, I will say, the way this regional market that we are in, it moves like this only. Even if you see the last year H2, we have earned a profit of around 31.94 crore in the H2 part, whereas H1 had a loss of around 13.27 crore. So basically the H2 will have a higher profitability and H1 will have a lower profitability.
So, I mean, I just want to get a hang of, what could be our sustainable margins going ahead. Yeah.
So, in terms of gross margin.
No, in terms of EBITDA. I'm more interested in EBITDA.
In terms of EBITDA, 14 to 15% is the guidance that we are going to reach. And even if you see the trailing 12 months number for this from September to last September, we are already at 14.5%. So we have already did 166 crores of EBITDA on trailing 12 months.
Mm-hmm. Oh, so 14 to 15% is your sustainable margin?
Yes.
Okay, sir. And I mean, since we have grown at 65% this quarter, I mean, your guidance as such is a bit conservative. Can we think that can I assume that we'll be growing our top line at a much larger pace?
We would like to grow, yeah, and we think we would be able to grow ourselves.
Okay, sir. Yeah, I'll again get back in the queue. Thank you.
Thank you. The next question is from the line of Arpit Shah from Stallion Asset. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir. Please go ahead.
Yeah, just wanted to understand the growth trends for the festive season. Let's say from Dussehra to Chhath Puja last year and this year. What kind of growth trends you would have seen?
So in terms of Dussehra to Chhath, because we are here for the Q2 call, I can just tell you for the festive season, the Durga Puja, we have seen a lot of good traction because Durga Puja was in the month of September this time. And overall, as I said, the entire first half was good with the 21% of L12 growth. So all the festivals put together in the first half has given us a good traction in the older stores.
But any idea on the trend? Where is it? Like, is it going to be a similar?
We see a good momentum continuing from September. So we see a good momentum in terms of sales in the October also.
Would you care to quantify that momentum?
Sorry, I cannot quantify right now. As this is a Q2 call, so I cannot quantify the number.
Got it. Not a problem. I just wanted to understand, last year Q3, probably our gross margins were around 37%. Because that was a stupendously high quarter at that point of time. And this year Q2 is a very high, big quarter for us. Now the gross margin is close to 30-31%. Now if we look at gross margins on a very seasonally high quarter, and the kind of PAT numbers, are we looking to grow on that, or maybe the PAT is going to be flattish for FY'25 against FY'24? Just wanted to understand trends on that.
So see, in terms of margin, because Q3 in across the retail is one of the best quarters. I think the best quarter among all the 4 quarters in terms of profitability. So the gross margin will be sustainable. It will be similar to last year, or maybe 50 basis point higher than that. In terms of PAT, as I said, that if you see the trailing 12-month numbers also, so last half year number, we did a 32 crore PAT in the second half, and a major contribution was coming from Q3 itself. So, that is already, if you see, the 40.89 was the PBT in trailing 12 months against 1143, and with the 2 more quarters left for this financial year, I think we will be easily able to meet all our guidance that we have set.
Got it. And I think you mentioned the sales guidance for the year earlier in the call. I just missed that number. What was that number?
So, in terms of PAT?
In terms of PAT and revenue both.
So, the PAT would be 2.5 to 3%.
Okay.
And in terms of revenue, it will be around 25%.
And 2.53% is post-Ind AS or pre-Ind AS?
It is post-Ind AS.
Post-Ind AS 3%. And what would be pre-Ind AS?
Pre-Ind AS would be 3.5 to 4.
Got it. Thank you so much.
Thank you. The next question is from the line of Arman from Blue Sky Capital. Please go ahead.
Yeah. Hi, thanks for the opportunity. First question, I would like to understand that what is an average time that a particular store takes to mature, and what is the average revenue for a mature store and the margin we can clock in for a mature store?
So in terms of the store's life cycle that we maintain is that whenever the store opens, so in the first year, at pre-Ind AS level, it gives us a profitability of around 5% in terms of EBITDA. In the second year, the first full year that which it runs, it gives us a EBITDA of around 10%, and in the third year, it gives us a EBITDA of around 15%. 14 to 15, 9 to 10, you can say that way.
Okay. Okay. Okay, got it. Got it. Got it. And since you have already revised the number of opening of the stores to 50, so what's the outlook for the FY'26 and FY'27?
It will be similar. On the similar line, we will be opening around 50 to 60 stores every year.
Okay. Okay. Thanks. Thanks a lot. That's it from us.
Thank you, sir. We take the next question from the line of Jagveer Singh from Shade Capital. Please go ahead.
Yes. Yeah, thanks for the opportunity. So then, we have this kind of strength in our business. In the long run, can we have the gross margins of 35% to 40%?
Can you just come again with your question? Actually, I was not able to hear you properly.
In the future, say in the next 2-3 years, so our business has this kind of strength that we can achieve the gross margin of 35 to 40%.
35 to 36% you are saying in gross margin?
Yes, yes. Yeah.
Yeah, see, we can achieve. It's not the case we cannot achieve it right now because we want to aggressively expand our private label. That's why we are we are not working on a very high gross margin structure, but yeah, it's easily achievable, 34 to 35%.
And then, what is the revenue mix in the second half and the first half? Percentage-wise, so...
Generally, the mix is between 43 to 48%. So H1 tends to be between 43 to 48, and the H2 is similarly. It totally depends on, because we are in the East India, and the Durga Puja plays a very important role. So if it falls in September, so the first half share increases, but typically it moves around 43 to 48%.
So because this year Durga Puja is from early, so we may have 50-50.
No, it will not. The 50 is not the case. It will be between 43 to 48.
Okay, sir. Thank you very much.
Thank you, sir. The next question is from the line of Devesh Advani from Reliance General Insurance. Please go ahead, sir.
Hello, am I audible?
Yeah, you're audible.
Yes, sir. Thanks for the opportunity. Sir, I wanted to understand that since you are already at 45 stores and already tracking a revenue of 41% in H1 FY'25, so why are you giving a low guidance of 25% revenue guidance for FY'25?
Actually, we are not giving low guidance on that because at the start we thought, at the initial start we thought of 25%, and the 41% has been created in the last 6 months, but 10 days it's a preponement of Durga Puja also. So considering that, we would like to deliver the stakeholders more on the revenue part, and just by being optimistic, we don't want to give any extra number. That's why we are sticking on our guidance of 25% only, because we want to see this Q3 also.
So we can see an upside more than 25% in H2?
20 to 25% will be the guidance for H2 in terms of revenue.
And as far as profits are concerned, the company is into losses. So when do you see the company being flourished into profits?
So in Q3 you will see it. As I said, as I already said that the H2 in the second half we have a huge profitability. Last year also we did a PAT of 32 crores in H2. So in Q3 you will see the profitability.
Okay, sir. Okay.
Thank you, sir. The next question is from the line of Shubh Shah from Ratnatraya Capital. Please go ahead.
Hello. Hello.
Yes, sir, please go ahead. You're audible.
Yeah. Sir, I wanted to know more about the cost structure. So starting from the employee cost, what is the quarterly run rate that we can assume going forward? Is it like 23 crores, 30 crores employee cost per quarter?
On an average, it's 190 rupees square feet cost that we take.
Mm-hmm.
And if you see in terms of absolute value, it will be hard to quantify, but yet in terms of percentage, you can say that approximately 24 to 25% is the cost.
Understood. And the rest of the costs, what proportion would move with the sales, and what proportion of the rest of the costs would be like fixed costs?
So generally, rental and the employee cost. The employee, I will not say rental is a fixed cost. Employee also, we tend to change the number of employees if we see a low sale, or if we see a high sale, we tend to increase the number of employees in that particular store. Rental is something which is a fixed cost. Apart from that, all the other costs are like variable only.
Understood. Exactly. And lastly, any guidance for same-store sales growth for the second half?
For the entire year, it will be 9 to 10%.
Okay, understood. That's all. Thank you.
Thank you, sir. The next question is from the line of Palash Kawale from Nuvama Wealth. Please go ahead.
Yeah, sir. Thank you for the opportunity again. Sir, so if I look at the Q2 numbers, you have grown by 65%, and even then the losses have contracted. So, even for other players also, the losses have contracted despite such a high growth. So, do you see in upcoming years that Q2 becoming a profitable for you?
Yeah, so for us, we may see next year it may become profitable for us.
Yeah.
See, lot of things depend on the festival shift. So basically, what happens is that because we are East India concentrated, and the Durga Puja seems to have fluctuation between September and October, and if we have got larger number of days in the month of September, we will be having a better profitability. Because July, August is one of the dull months across the retail, in which you have end of season sale and everything. So as a result, September plays a crucial part in terms of profitability.
Okay. Yeah, sir. Thank you for that. And sir, what is the average rent per square feet for you?
Can you just come again?
What is the rent per square feet rentals?
42 to 45 per square feet per month.
Sorry, could you?
42 to 45 per square feet per month.
Okay. Thank you for that. And sir, you will be adding stores aggressively even in next 2 years. So what is that aspirational PSF that you're looking for to achieve in, let's say, by end of FY'26 or FY'27?
See, in terms of PSF now, we are very simple structuring that we want to have a bottom line along with the top line. So the thing that we have done is that now we are following the cluster-based approach, in which we are enhancing our brand visibility in existing cluster and improving our supply chain also that way. So in terms of PSF, you can say that 5% is the increment that we are looking every year in terms of number if you want. And we will be able to do it because I think because of this cluster-based thing.
Okay, sir. Thank you for that. And sir, one last question. How were the Diwali footfalls? Because one of your peers have said that the footfalls were good, but not as good as expected. So was it you had a very healthy growth in terms of Diwali footfalls?
The overall, as I said, the momentum that started in September, it was there in October also. So for us, the momentum was good in October.
Okay, sir. That's it from my side. Thank you very much for your answers.
Thank you.
Thank you, sir. The next question is from the line of Varun Singh from AAA PMS. Please go ahead, sir.
Am I audible?
Yes, sir. Please go ahead.
Okay. Thank you. Thanks for the opportunity. So my first question is, what percentage of our revenue is from full price sale?
So 88% is the full price sale through for the first half.
All right. And secondly, please correct me if I heard this wrong. You guided for 25% revenue growth in FY'25. Is that number correct?
Yeah.
Okay. So in that context, just wanted to understand that given 50 to 60 store addition aspiration that we have, so that is roughly 33-35% kind of a retail area expansion. So, I mean, with 35% retail area expansion, 25% revenue growth, are we expecting second half to be, I mean, moderate or negative in terms of same store sales growth?
So as I said, now for the entire year, the guidance would be around 9 to 10% for the LTL growth. Yeah, and in terms of growth, now so all the stores that are opening this year will give a full sale through for the entire year in the next year. So I think we are trying to open higher stores in the first half itself, so as I said, we are already at 198 stores as we speak, just to have the higher revenue in the second half.
Okay. So, all right. Okay. So secondly, on gross margin expansion that we have seen, and as you have also commented that we'll prioritize bottom line over the top line. Just wanted to understand that why not become even more competitive by reducing prices for the customers instead of prioritizing margin expansion.
So see, in terms of margin expenses, we are not increasing it at a very high percentage. Our guidance for this year is only between 33 to 34. So the guidance that we have taken is only an increase of for the 1% maybe from last year itself. Nothing more than that. That's a 0.5%. Last year it was 33.5 and we are taking 34%. And that also we are taking on the account of private label because we have increased our private label share to 50%. And the price that we are offering is almost at the very low side only. And people are liking. You have to focus more on quality and designing into the product. If you have that now, I think 0.5%, 1% you can earn if you are focusing on that.
All right. And so last question is on marketing spend. Given that we have increased it to now 1.6% of revenue, just wanted to understand that where are we spending this money?
So see, mostly we are trying to do it more on a regional way, and our marketing spend is with the collaboration with the local influencer, regional celebrities. For example, UP, Bihar also we have signed up with a regional celebrity. In Bengal, we also have a regional face, and with creating a lot of commercial videos with them, more on a digital front, at local BTL activities, hoardings, newspaper at regional level, pamphlet distribution, photo branding. There's a lot of things that we do. But we try to do it more on a regional side, at a store level.
Bulk of it would basically be spent on the regional celebrities. Is that correct understanding?
Yeah, we are spending on regional. So for example, right now also if you see one of the videos that we have created, our commercial song video of Kesari Dal has got more than 26 lakhs views in UP Bihar. And it has been a super hit and it's a top trending songs on YouTube. Around 15 or top 15 trending songs on YouTube. So that way we create that type of buzz along with the local celebrities.
Okay, all right. So that's it from my side. Wish you all the best. Thank you.
Thank you, sir. Next question is from the line of Siddharth from Caprise Investment Management. Please go ahead.
Yeah. Hi, sir. So just wanted to confirm, if in the first half, we had a PAT of, we made a PAT of close to 23 crore, right? Negative 23 crore, right?
PAT of?
Minus 23 crore.
For the first half, it's 9.28 after exceptional loss. Before exceptional loss, it's 1.66 here.
Okay. So now, as per your guidance, you're saying that 2.5% is, the guided PAT margin. That translates to close. 30 crore, if I'm not wrong.
30 crore. I don't know, how do you calculate it? But on the top line, whatever top line that we are creating, it will be on 2.5% on that.
Okay. Okay. Yeah, got it.
2.5 to 3%. 30 crore that you are seeing is for the trailing 12 months, and still the 2 quarters are left for this year. If you take that trailing 12 months, we are at 40 crores PBT, which translates to 30 crores of.
Got it. Thank you, sir. Yeah, that's it from us.
Thank you, sir. The next question is from the line of Devesh Advani from Reliance General Insurance. Please go ahead.
Yes. Actually, sir, as far as your sales mix is concerned, I'm seeing that there is a slight shift from general merchandise to apparels, wherein apparels are have increased from 82% in last quarter to 86.7% in this quarter. So what has been the reason for this shift, and what are the margins, if you can bifurcate in terms of apparels and general merchandise?
So basically this shift is because of the shift of the festive. So whenever there is a festive coming into a particular month, the sale of garments increases.
Okay.
As a result, there is a shift in the mix. Otherwise, for the entire year, the mix remains almost on the similar side.
Okay. And what is the margins with respect to apparels and general merchandise?
General merchandise range between 30 to 32%, and apparels range between 33 to 35%.
Okay. All right, sir.
Thank you. The next question is from the line of Shreyansh J from Swan Investments. Please go ahead.
Hello. So you mentioned that full price sales for H1 was 88%. Can you help me with the same number for last year, H1 FY'24?
For the entire FY'24, it was 86%. That number is handy with me right now.
H1 of last year.
H1 number is not handy with right now with me.
And full year you're saying was how much?
86% for entire FY'24.
86%. Okay. So my next question is, you just mentioned GMs on general merchandise at 32%. So which are the products that you sell in this general merchandise?
So when I say GM, it consists of a lot of things. For example, plasticware, bed and linen, imitation jewelry, cosmetic section, luggage bag, cosmetic. Yeah, these are the things that we generally sell in the stores.
Okay. And so when you open a store, what is per square foot cost that you have to incur? Just if you could help us understand the unit economics for a store capex.
On an average, a store costs between 1 to 1.25 crores, depending on the tier that we are opening.
Okay. And all our stores are on rent. Is that a fair understanding, or you own the stores?
Yes.
We have 6 owned stores.
Out of
rest are leased.
Okay. So 1 to 1.5 is only inventory you're saying, or it includes your furniture, fixtures, lighting?
Only the capex part.
Only capex. So inventory would be another how much, sir?
Another 1 CR.
So basically 2.5 CR for a store.
But 2 crores. 2 crores, 2.25. 0.25 that I'm telling is of the stores which are opening in the tier 1 cities, where we try to enhance the look. And in terms of per square feet, it is around between 1,200 to 1,400 rupees per square feet cost.
Okay. And sir, typically when you open a store, what are the sales per square foot that you envisage? Say, can you just help me understand the journey from year 1 to, say, when you reach matured, when a store reaches maturity? So what is this SPSF like, sir, from year 1, year 2, year 3? How does it move?
Basically, how we see now, we focus more on the EBITDA front when we open a store. So the journey goes like this. If you are opening a store in a city, it will have a higher SPSF but lower EBITDA. But if you are opening a city in tier 2, tier 1, it will have a higher EBITDA but lower SPSF. In general, a store tends to have this life cycle that when you're opening a store, the newer store will have a EBITDA of around 5% in the opening year. So on an average, for example, all the stores that have been open in 23-24 for the entire financial year, that was around 5% EBITDA positive. So best part about this segment is that from year 1 itself, the entire cluster is positive. When it gets into the second year, which is a full 1 year running, it goes from 5 to around 9 to 10% as EBITDA. And once it reaches the maturity stage, which is 2 to 3, it tends to have a EBITDA of around 14 to 15%, all at pre-Ind AS levels.
Acha, all these numbers are pre-Ind AS.
Yeah.
And sir, when you guided for 14 to 15% of EBITDA margins, this was post-Ind AS, or this also was pre-Ind AS for the company you're saying?
So it was a post-Ind AS. I am talking all the numbers post-Ind AS because we are talking on the store EBITDA side. That's why I just give you the pre-Ind AS numbers. Because store EBITDA rental is very important, so I just want to share that.
Okay. And sir, just last question. So when you said rent for you is about 40 to 45 rupees a square foot, is that on the lower side? Because I think most retailers say 50 to 60 rupees per square foot is their rental cost.
Yeah, it is lower. I will not say it's on the lower side, but it is because of the way our stores have that mixed in tier 2, tier 3, tier 4 cities. Because if you see, almost more than 60-65% of the stores is in tier 3, tier 4. Okay. And then tier 2, tier 1 is also there. So because we have a lesser presence in the cities and tier 1, as a result, we tend to have a lower cost on the rental per square feet.
Okay. All right, sir. Thank you and all the best.
Thank you.
Thank you. Before we take the next question, a reminder to all the participants, if you wish to join the question queue, you may press star and 1 on your touchtone telephone. We take the next question from the line of Arpit Shah from Stallion Asset. Please go ahead.
Yeah, hi. Thank you for the opportunity again. Just wanted to understand more on the inventory bit. Like you just mentioned, our inventory is about 1 crore a store, and we have about 198 stores. And the inventory is about 450 crores in the September balance sheet. So I did not understand the math behind that.
So basically, the October is a festive month, and we have to build up inventory. If you see this, if you see in terms of efficiency, you will see that last year the inventory per square feet is around 2,884 square feet on the 30th September, which is reduced by 200 rupees square feet, and is around 2,688 square feet. In terms of inventory days, but from 154 it has got to 137 days, and because of the festival, we have to build up inventory just before the festival in the stores. That is why you are seeing a difference of in terms of inventory numbers. Because
even if I take the March 24 ending, that inventory number is at 433 crores.
Correct.
That time of store is also on the lower end compared to what we have now. So if you are mentioning about 1 crore per store inventory, the number is broadly more than double of that. So what is that missing?
1 crore is a paid inventory. So we were talking about how much is the investment. So 1 crore is the paid portion of the inventory.
So everything is paid, right? It's inventory.
No. So basically how it goes is that we get a crate from the vendors, and when we say a calculation that the person was asking, so I just told him that 1 crore is the capex investment. He was asking for the investment and how much investment is going to be made on the inventory side. So it's a 1 crore on the paid inventory side. So typically a store will have an inventory of 1.5 to 2 CR as an entire store.
Got it. So let's say if the inventory is 2 crore on the store, 1 crore is on credit and 1 crore you would have paid for it.
Yeah, you can say that. That is the way.
Okay. Thank you.
Thank you, sir. The next question is from the line of Simanto Saini, an individual investor. Please go ahead.
Yeah, hi. Thanks for providing the opportunity. I just wanted to know that in Q1 we had a fire in one of our warehouse. So when we can expect the claim amount?
So the paperwork has been done, and I think we can expect the entire insurance claim to get settled within this financial year.
Okay, so maybe by Q4 we can expect that?
Yeah, we can expect the interim claim in Q3 itself, and Q4 everything should get settled.
Okay, and in terms of the marketing and advertisement cost, what is that percentage?
So it ranges between 1.5 to 2% for because in Q3 we have to build a lot of marketing for the Durga Puja. So for this Q2 it is around 1.96%, 2.2%, sorry. But for the entire, it will be between 1.5 to 2%.
Hello? Hello, sir, can you hear me?
Yeah.
Mr. Saini? Mr. Saini, are you done with your question? Hello? As there is no response from the line of the current questioner, we move on to the next question. Before we take the next question, a reminder to the participants, if you wish to join the question queue, you may press star and one on your touchtone phone telephone. Ladies and gentlemen, if you wish to join the question queue, you may press star and one on your touchtone telephone. The next question is from the line of Vibhor Halan, an individual investor. Please go ahead.
Hi, thanks for the opportunity. Just want to ask, I think we are planning to open around 50 stores, and what I heard is that the capex per store is about 2 crores, right? So total of 100 crores investment. So how do you want to fund this capex? What is the plan to fund this capex? How much through debt and how much through profitability, internal accruals?
The capex investment is 1 crore and 1 crore is towards the inventory. So 1 crore is taken under the cash flow from operation against the inventory. So if it takes for the capex only, the capex will be 1 crore, and if we open 45 to 50 crore, it will be around 45 to 50 CR. And PAT plus depreciation is enough to cover the capex investment.
Got it. So entire funding of the store expansion will be done by internal accruals, right?
Yes, sir.
And what is your plan for repayment of the borrowings in the near future?
Basically, if you see, we at present we have 39 CRs borrowing, and bank and cash and bank balance 17 CR. So going forward, we will repay debt completely. We will be debt free.
By when, sir?
Means it is an ongoing, so we cannot say much. We will be utilizing minimum of the loan.
Okay.
As you already seen the half-yearly balance sheet also, no? So the 17 crore is the cash and bank balance available, and 39 is the utilized amount. And the insurance claim is still awaited. So technically, if you see, if the insurance claim would have been received, then we would have been debt-free as of 30th September itself.
Got it. Another question is that I saw results for one of your competitor, V2 Retail. They have posted an EBITDA margin of 10% plus, whereas we are around, I think, about 8% in Q2. So what is the reason of our lower EBITDA margin versus the competition in the same quarter this year? Despite
our EBITDA margin stands at 8%, and I think I have not seen the V2 numbers, but if you compare for the entire last trailing 12 months, it's around 11.3% for us, 14.6% for us as a TTM level, and as I said, for us, I think we have done very good numbers, set of numbers compared to last year, and we would continue to do well. I haven't seen the V2 numbers.
Okay. And the last question from my side is that you have guided for 14 to 15% EBITDA margin for next year. What is the guidance for PAT margin for next year?
2.5 to 3% on post-Ind AS and 3.5 to 4% on pre-Ind AS.
So no increase from this year, right? Next year that you're guiding.
So the long-term guidance will be 4 to 5% on post-Ind AS in next 2 years. So for this, you can say 2.5 to 3, and in next 2 years, we will try to reach between 4 to 5 on post-Ind AS.
Okay. And the growth that you said that you would do next year would also be 25% for FY'26, right?
Yeah.
Got it.
We will continue to grow at a CAGR of 25% in future also.
Thank you. That's it from my side as of now. I'll join the queue.
Thank you. The next question is from the line of Harsh Shah from Bandhan AMC. Please go ahead.
Yeah, hi, Shreyans and team. Thanks for taking my question. I'm sorry I joined a bit late. Sorry if you've answered this question before, but what has been, if you compare the festive to festive, right, like the 45-day period starting before Pujo till the end of Diwali, what has been the SSG growth for this for that period? If you could talk about it.
In terms of September month has been good for us because some part of festival falls in October also. So I will not be able to quantify in terms of number, in terms of the growth that we have done. But yeah, the momentum was very good in September, and we have seen a good growth in the festive season that way.
Okay. And do you see this momentum continuing for us as well, like say going into November post-festive, or there is some bit of normal that slowdown which we see after the festive, which we are witnessing now?
So in terms of festive, the momentum was there in both in the month of September and October, and right now we are focusing more on the wedding and winter. For now, the Chhath and everything is over. So and there's a lot of wedding this time. The way we see in calendar, so we can see a good traction in terms of sales from wedding and from winter going forward.
And just in terms of inventory days, right? If you compare March 24 to March 25, where do you see inventory days settling for March 25 versus March 24? I know it's seasonal, so we can't compare March and September, but if you were to compare March to March, how much improvement do you foresee in your inventory days?
If you see the September numbers now, you will see that we have reduced from last September, this has reduced to 200 rupees square feet. So we had 2884 rupees square feet of inventory on 30th September 24, and right now we are standing at 2688. And the way we see, we will see this particular momentum is going to continue for the next few quarters, and we will be able to reduce it further. So from March to 954, we have reached 2688 for H1 FY'25. So we have already reduced from March to September, we have reduced 300 rupees square feet, and going between 250 to 300 rupees square feet, and in next 6 months also we will be keep reducing the inventory.
This is despite the seasonality where you have much more inventory towards the end of March, right? Despite that, you are saying that the inventory will reduce even compared to September levels in March 25.
Yes, it will get reduced.
Excellent. And sorry, could you offer your comments on store opening guidance for this year and the next year?
So the earlier guidance was to open around 35 to 40 stores for this financial year, but we will be opening 45 to 50 stores for FY'25, and next 2 financial years we will be targeting 50 to 60 stores every year.
And this will so I believe that most of our stores were spread across, in tier 2 and below cities, right? So now going ahead, will we be targeting the same tier 2 and below cohort, or let's say even metro in tier 1 is something which we would focus on?
So we have started with metros. So we have opened a couple of stores in Kolkata city itself, and we are seeing a lot of traction coming in. A very good high PSF sales is generating by Kolkata itself. So you will see a mix of both. So we will be keep focusing on tier 2, tier 3 where we have built a fort, and with that we will be focusing on cities also.
And are the payback periods similar for the stores which you open in metros versus let's say tier 2 city?
Yeah, in terms of absolute value, I think it tends to land at the similar levels. But if you see in terms of percentage of EBITDA, so the tier 2, tier 3 will be having a higher EBITDA. But the PSF that they tend to generate in terms of absolute value, they tend to generate a higher value. So the payback period is similar for both of them.
Got it. Thank you, and wish you all the best.
Thank you. The next question is from the line of Varun Singh from AAA PMS. Please go ahead, sir.
Yeah, thanks for the opportunity. Sir, I was just looking at your cash flow statements in FY'24 in investing activity, 85 crore is what is the capex amount, and we have added around 27 odd stores in the year FY'24. So the capex per store number comes at around 3 crore, whereas like as you guided that we would be needing maybe 50 odd crore for the capex and another 50 odd crore for the inventory stuff. So, I mean, where am I getting this question wrong? Can you please help me understand?
Yeah, last year, basically, we had purchased 3 new stores in Q3. So basically, the CapEx investment was high in that quarter. So, and secondly, we have entered into agreement for new warehouse. So for that also, some CapEx investment was also made. So, for that, the cost has shoot up, CapEx cost has shoot up last year.
Okay, understood. And secondly, sir, like if I compare our inventory days compared to peers in the same geography doing into same category, it appears to be almost 60% higher. So what explains that?
I don't in terms of peers when we say, so we generally the peers numbers are almost on a similar side for us because September and March tends to be higher because of the regional I will say allocation of stores. So we tend to have a particular festival in the month of April in Bengal and again in the October, and because Bengal and this Odisha plus Assam plays a very pivotal role for us because they are our core states. So as a result, we tend to have a higher inventory on those 2 months, September and March. And that is the reason the inventory is there. Otherwise, if you see the inventory, if you see in terms of churning, it is good only. It's just that because we are opening so many stores, so you tend to see it at 137 days. But if you annualize the entire revenue that is going to be generated by that store, because we have taken the stock also. So stock has been taken for the entire year, but the revenue has not been made for the entire year. So if the annualized sale is there, so this will reduce drastically.
Okay, no, I was just comparing FY'24 and computing this inventory days on the COG. So in our case, and given that we have added 25-30 stores only in FY'24, maybe the number is comparable with other players also. So our case, that number stands at roughly around 245 days, whereas for others, it is around 155 to 160 days. And I mean, this number I was just tying up with 88-90% of full price sale that we have done. So I was unable to understand that what explains this differential.
So you're talking on revenue, correct? The inventory note is on revenue basis?
No, on COGS.
So see, for us, as I said, now on 31st March, we tend to have a high inventory just because of the season. So this year, as an FY'24, we have got a early Eid in the month of April, and because as I said, a particular festival is there in Assam, which is Bihu, and in Bengal, which is Chetro, which comes between 1st to 15th of April. As a result, April becomes a very heavy month for us in terms of revenue, and we have to keep a higher inventory on 31st March. That is the reason you see a higher traction of inventory compared to the peers that we keep, because the peers have got the allocation across the states. So they are having presence across India. So as a result, their inventory tends to be on a lighter note on 31st March. But in our scenario, because we are geographically inclined towards East India more, as a result, we have to have a higher inventory, particularly for 31st March and 30th September, because of Durga Puja and Chetro Bihu for Bengal and Assam in the month of April, along with Eid.
Understood. So that is very much clear. And sir, just last question on EBITDA per square feet. So for our matured store, as you highlighted that EBITDA margin moves from 5% to 15% in the third year. So in the third year itself, what is the EBITDA per square feet generated by the store? And also revenue per square feet, if you can give both these numbers.
Typically, see, as I said, I will just want to clarify one thing in terms of revenue per square feet. Revenue per square feet is not a correct benchmark to see when you see a store, because what we have learned over the years, that when you are going to open stores in tier 2, tier 3, tier 4, you will tend to have a lower PSF, but your EBITDA percentage will be on a higher side, because the costs are lower. So on an average, if I say in terms of percentage, so 15% is the EBITDA that we are generating in the mature stores, and 4.5 to 5% is the corporate overhead. So on the maturity stage, it gives us a EBITDA of around 10%.
Okay, sir. Okay, that's it from my side, sir. Thank you very much.
Thank you. Ladies and gentlemen, in interest of time, we take that as the last question. I would now like to hand the conference over to the management for closing comments.
Thank you all for making it to our quarterly earning calls for Q2 and H1 FY'25. If there are any further queries, please feel free to reach out to Stellar IR Advisors. Thank you one and all. Have a nice day.
Thank you. On behalf of Bazaar Style Retail Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.